I am about to tell you about the single best investment opportunity I have found in years. An investment so compelling that I have made it my largest position. An investment that combines everything I look for in a great business: durable competitive advantages, pricing power, recurring revenue, massive growth potential, and a valuation that dramatically underestimates what this company is truly worth. I am talking about Universal Music Group, the largest music company in the world, the owner of the most valuable collection of songs and recordings ever assembled, and the company that I believe will generate extraordinary returns for patient investors over the next decade. Let me be clear about something from the start. I do not make investment recommendations lightly. I spend months, sometimes years, analyzing a company before I commit significant capital. I study the business model exhaustively. I speak with management, competitors, suppliers, and customers. I build detailed financial models. I stress test my assumptions. I look for every possible reason I could be wrong. After all of that work on Universal Music Group, I am more convinced than ever that this is a generational investment opportunity, the kind of opportunity that comes along once or twice in a career, the kind of investment that can define a portfolio for years to come. Today, I am going to explain exactly why I am so bullish on Universal Music Group. I am going to walk you through the business model, the competitive advantages, the growth drivers, and the valuation. By the end, you will understand why I have made this my biggest bet for 2026 and beyond. Let me start with some history, because understanding how we got here is essential to understanding why the opportunity exists today. The music industry went through a catastrophic decline in the 2000s, and piracy led by Napster and then countless file-sharing services devastated the business. Why would anyone pay for music when they could download it for free? Revenue collapsed by more than half. Record labels that had been cash machines became struggling enterprises. Artists could not make money from recordings. The entire ecosystem seemed broken beyond repair. I watched this unfold with fascination. The music industry's near-death experience was one of the most dramatic business disruptions in modern history. An entire industry's business model was destroyed almost overnight by technology. It seemed like recorded music might never recover. Analysts wrote obituaries for the major record labels. Everyone assumed digital piracy had permanently destroyed the value of music. But then something remarkable happened. Streaming emerged as a new distribution model, and it saved the industry. Services like Spotify, Apple Music, Amazon Music, and YouTube Music offered consumers a legal, convenient, affordable way to access virtually all the music ever recorded. For $10 or $15 per month, you could listen to anything you wanted, anytime, anywhere, no piracy required. The streaming model worked because it was actually better than piracy. It was more convenient, the sound quality was better, the libraries were comprehensive, the user experience was superior, and the price was low enough that most people were willing to pay rather than deal with the hassle and risks of illegal downloads. The result has been a stunning recovery for the music industry. After bottoming out around 2014, global recorded music revenue has grown every single year. The industry is now larger than it was before the piracy crisis, and it is still growing rapidly. Streaming revenue continues to compound at double-digit rates globally. The recovery is real, durable, and far from complete. This is the context for understanding Universal Music Group. The company is the largest beneficiary of the streaming revolution. It owns the most valuable catalog of music in the world, and it is positioned to capture an enormous share of the industry's continued growth. Let me explain what Universal Music Group actually owns, because the asset base is extraordinary. Universal owns the recordings and publishing rights to the most successful artists in music history: the Beatles, the Rolling Stones, Taylor Swift's early catalog, Drake, Billie Eilish, The Weeknd, Post Malone, Ariana Grande, Lady Gaga, Elton John, Queen, ABBA, Bob Dylan, Joni Mitchell, U2, Nirvana, Guns N' Roses, Def Leppard. The list goes on and on. Every genre, every era, every corner of the musical landscape. The company represents about 1/3 of all global recorded music revenue. 1 out of every $3 spent on music worldwide flows to Universal Music Group or its artists. This market share has been remarkably stable over time because the catalog assets are irreplaceable. You cannot recreate musical history. You cannot manufacture another Beatles or another Queen. Those artists exist, their recordings exist, and Universal owns the rights. Think about what this means. If you want to listen to the Beatles, you need Universal's permission. If you want to stream Drake's latest album, Universal gets paid. If a movie wants to use a Rolling Stones song, Universal collects the licensing fee. If a television commercial wants to feature an iconic song, Universal negotiates the deal. The company sits at the center of the entire music ecosystem. The catalog is the key asset, and it is essentially irreplaceable. Nobody can create another Abbey Road or another Purple Rain or another Thriller. Those recordings exist and will never be duplicated. They have been part of our cultural fabric for decades and will remain so for decades to come. New hits will be created, but the old hits never go away. People still listen to music from the 1960s and 70s and 80s every single day. This creates an incredible business model. Universal's catalog generates revenue in perpetuity with minimal ongoing investment required. The recordings are already made. The songs are already written. The company simply collects payments every time someone streams a song, licenses a recording, or uses music in any commercial context. It is about as close to a royalty business as exists in the public markets. Now let me explain why the streaming model is so powerful for Universal specifically. In the old world of physical music sales, revenue was lumpy and unpredictable. A hit album could generate enormous revenue in its first few weeks, then sales would fall off a cliff. The business was driven by new releases. If the release pipeline was strong, revenue was strong. If new albums disappointed, revenue collapsed. This made the business volatile and difficult to predict. Streaming completely changed this dynamic. In the streaming world, catalog music generates a large and growing share of revenue. People do not just stream new releases. They stream music from decades past. They create playlists, mixing new songs with old favorites. They discover classic albums through algorithmic recommendations. The result is that older music generates significant and predictable revenue year after year. For Universal, this means that revenue is far more stable and predictable than it used to be. The catalog provides a foundation of recurring revenue that grows steadily regardless of whether any particular new release succeeds. New hits add to the catalog over time, compounding the asset base. But even in a year with weak new releases, the catalog keeps generating substantial cash flow. The streaming model also expanded the addressable market dramatically. In the physical world, music purchases were concentrated among dedicated fans who bought albums. Most people listened to the radio or borrowed CDs from friends. They were not generating revenue for the industry. Streaming converted many of these casual listeners into paying customers. For $10 a month, they could access all the music they wanted. Many people who never would have bought a CD subscribe to streaming services. The result is that the music industry's total addressable market is much larger than it appeared during the CD era. There are billions of people globally who have smartphones and internet access but do not yet subscribe to paid streaming services. As these markets develop, as incomes rise, as streaming services expand their reach, the industry will continue to grow for many years. Let me quantify the growth opportunity because the numbers are staggering. Global paid music streaming subscribers have grown from essentially zero in 2010 to over 600 million today. That is remarkable growth, but it still represents a small fraction of the potential market. There are over 4 billion smartphone users globally. If even half of them eventually subscribe to paid streaming, that would represent another 1.5 billion subscribers, nearly tripling the current base. Penetration varies dramatically by region. In developed markets like the United States and Western Europe, streaming adoption is relatively mature but still growing. In emerging markets like India, Brazil, Indonesia, and much of Africa, penetration is in the low single digits. These markets have enormous populations, rapidly growing middle classes, and increasing smartphone adoption. They represent decades of growth potential for the streaming industry. Even in mature markets, there is room for growth through price increases. Streaming prices have been remarkably stable for years. Spotify launched at $10 per month in the United States, and that price barely budged for over a decade. Only recently have streaming services begun testing price increases. The response has been encouraging. Churn rates have remained low despite higher prices, suggesting consumers value the service enough to absorb increases. This pricing power will become increasingly important over time. As streaming services raise prices gradually, the revenue pool available to music rights holders like Universal grows accordingly. A 10% price increase flows almost entirely to the bottom line for Universal because their costs do not rise proportionally. Let me share a story that illustrates why I believe so strongly in this investment. Several years ago, I was having dinner with a friend who runs a large private equity fund. He specializes in acquiring royalty streams and long-duration assets. We got to talking about music catalogs, and he told me something that stuck with me. He said that his fund had been looking at acquiring music catalogs for years, but kept getting outbid. Every time a significant catalog came to market, whether it was a legendary artist selling their life's work or a smaller collection of valuable songs, the bids would come in far higher than his models suggested were reasonable. He could not understand who was paying these prices or how they could possibly make the numbers work. Then he did more research and realized something important. The buyers were not overpaying. They were paying fair value based on a more accurate understanding of how long these assets would generate cash flow and how much that cash flow would grow over time. His models were too conservative. He was underestimating both the duration and the growth of music royalty streams. This conversation planted a seed in my mind. If sophisticated private equity buyers were paying premium valuations for music catalogs, and if those valuations turned out to be justified based on actual performance, then perhaps the public market was undervaluing the largest and best music catalog in the world. When I started analyzing Universal Music Group in depth, I discovered that my friend's insight was exactly right. The public market was applying a discount to Universal that made no sense given the quality and durability of the assets. Private buyers were paying 15, 20, even 25 times annual royalties for individual catalogs. Universal was trading at a meaningful discount to those multiples despite owning a far superior, more diversified collection of assets. This disconnect between public and private market valuations is exactly the kind of opportunity I look for. When I can buy a dollar for 50 or 60 cents simply because the public market does not understand an asset as well as private buyers do, that is when I get excited. Let me explain Universal's competitive position and why the advantages are so durable. Universal Music Group has 3 primary business segments, and each has significant competitive advantages. The recorded music segment owns and licenses sound recordings. This is the largest segment and includes all the master recordings from Universal's vast artist roster. The competitive advantage here is the catalog itself. Universal owns recordings that cannot be replicated. There is only one master recording of Hotel California by the Eagles, only one original Bohemian Rhapsody by Queen. These assets are permanently scarce. The recorded music business also benefits from scale advantages in artist development and marketing. Universal has the resources to invest heavily in breaking new artists globally. They have relationships with radio stations, streaming platforms, brand partners, and media outlets worldwide. They can promote a new artist in ways that independent labels simply cannot match. This gives Universal a significant advantage in signing and developing new talent, which replenishes the catalog over time. The music publishing segment owns and administers the rights to musical compositions. This is distinct from the recordings themselves. The publishing rights cover the underlying songs, the words, and music as written. Publishing generates revenue whenever a song is performed publicly, broadcast on radio, streamed, synchronized in film or television, or reproduced in any form. Publishing revenue is even more stable and recurring than recorded music revenue. Compositions generate royalties in perpetuity as long as the copyright remains valid. A song written 50 years ago continues generating publishing royalties today every time it is played. Publishing is essentially a royalty stream with minimal ongoing costs. Universal Music Publishing is the second largest music publisher in the world, representing iconic songwriters and a vast catalog of compositions. The publishing business benefits from the same streaming tailwinds as recorded music, plus additional growth from synchronization licensing as content production expands globally. The merchandising and other segment handles artist merchandise, brand partnerships, and other revenue streams. While smaller than the other segments, merchandising provides additional monetization opportunities for Universal's artist roster and contributes to overall profitability. The combination of these 3 segments creates a diversified, resilient business model. Universal captures value across the entire music value chain. This diversification reduces risk while maximizing the monetization potential of the artist's relationships and catalog assets. Now let me discuss why management quality matters and why Universal's leadership is exceptional. Universal Music Group is led by Lucian Grange, who has been running the company for over a decade. Grange is widely regarded as the most talented executive in the music industry. He built Universal into its dominant market position through a combination of strategic acquisitions, artist development, and operational excellence. Grange understands the music business at a deep level. He started his career as a talent scout, signing artists and developing careers. He rose through the ranks by demonstrating an exceptional ability to identify talent and build commercial success. This background gives him credibility with artists and creative teams that corporate executives from other industries simply cannot match. Under Grange's leadership, Universal has consistently gained market share. The company has signed or retained the most important artists in popular music. It has successfully navigated the transition from physical to streaming. It has expanded publishing and merchandising businesses, and it has maintained strong relationships with streaming platforms while advocating effectively for higher royalty rates. Management incentives are well aligned with shareholders. Grange and other executives own significant equity in the company. They benefit when the stock performs well and suffer when it does not. This alignment is exactly what I look for in any investment. I have spent considerable time with Universal's management team, and I have been consistently impressed. They understand the strategic landscape. They think long-term. They allocate capital intelligently. They communicate honestly with shareholders. These qualities are essential for long-term value creation, and Universal has them in abundance. Let me address the risks and concerns about Universal Music Group, because no investment is without challenges. The most common concern I hear is about artificial intelligence and its potential impact on the music industry. Critics argue that AI will be able to generate music that rivals human artists, flooding the market with content and reducing the value of existing catalogs. I have studied this issue extensively, and I believe the concerns are dramatically overstated. Music is fundamentally about human connection and emotional resonance. People listen to artists they admire, whose stories they relate to, whose personalities they connect with. A song generated by artificial intelligence lacks that human element. It may sound pleasant, but it does not carry the meaning and cultural significance that makes music valuable. Think about why people pay to see live concerts. It is not just about the music. It is about the experience of being in the presence of an artist they love. It is about the connection between performer and audience. It is about shared emotional experiences with other fans. AI cannot replicate any of this. The most successful music throughout history has been tied to specific artists with compelling stories and authentic voices. The Beatles were not successful just because their melodies were catchy. They were successful because they represented a cultural moment, because their personalities resonated with fans, because their artistic evolution told a story. No AI can replicate that. Furthermore, AI-generated content will likely face significant legal and regulatory challenges. Music created using training data from copyrighted recordings may itself be subject to copyright claims. Platforms may be required to label or restrict AI-generated content. Artists and rights holders will advocate strongly for protections against unauthorized use of their voices and styles. I actually believe AI could be beneficial for Universal in some ways. AI tools can help with music discovery, helping fans find catalog music they would enjoy. They can assist in production and recording, reducing costs. They can create new monetization opportunities through personalized experiences. The threat is real but manageable, and the opportunities may ultimately outweigh the risks. Another concern is competition from independent artists and labels. As distribution has become democratized through streaming, artists can theoretically reach audiences without major label support. Some argue this will erode the market share of companies like Universal over time. Again, I believe this concern is overblown. While independent distribution is easier than ever, breaking an artist globally still requires enormous resources. Marketing, radio promotion, playlist placement, brand partnerships, global coordination. These capabilities require scale and relationships that independent artists and small labels simply do not have. The major labels have actually maintained or gained market share in the streaming era despite predictions that they would become irrelevant. Additionally, Universal provides real value to artists beyond distribution. They offer advances that fund recordings and tours. They provide creative support and career guidance. They handle complex international licensing and royalty collection. They protect copyrights and pursue infringers. These services matter, and successful artists generally choose to work with major labels even when independent options exist. A third concern is the concentration of revenue among streaming platforms. Spotify, Apple Music, Amazon Music, and YouTube account for the vast majority of streaming revenue. If these platforms use their leverage to reduce royalty rates, Universal's revenue would suffer. This risk is real but mitigated by several factors. First, the streaming platforms compete with each other for content. They need Universal's catalog to attract and retain subscribers. If Spotify offered lower royalty rates than Apple, artists might favor Apple exclusives, weakening Spotify's competitive position. This competition limits the platform's ability to extract value from rights holders. Second, Universal and other major labels have demonstrated willingness to play hardball in negotiations. They have threatened to withhold content and have walked away from deals that did not meet their requirements. The platforms know that Universal has leverage because the catalog is irreplaceable. Third, the overall streaming pie continues to grow rapidly. Even if royalty rates came under some pressure, which I do not expect, absolute revenue could still grow as the market expands. The combination of volume growth and pricing power provides multiple paths to revenue growth. Let me tell you another story that shaped my conviction in this investment. A few years ago, I was talking with a prominent music industry executive at a conference. I asked him what he thought was the most underappreciated aspect of the music business. His answer surprised me. He said that most investors focus on new releases and hit songs. They track which albums are charting and which artists are trending. But he said the real value in music was in the catalog, the vast library of songs that generate revenue year after year without any additional investment. He explained that a hit song from the 1980s generates almost as much revenue today as it did at its peak. People still listen to those songs. They still stream them. They still want them in movies and commercials. The songs have become part of the cultural fabric and will remain so indefinitely. He made an analogy to real estate. A hit song is like a building in a prime location. Once you build it, it generates rent forever. You have to maintain it and manage it, but the core asset just keeps producing income. And unlike a building, a hit song does not deteriorate over time. It does not need a new roof or updated electrical systems. It just keeps generating royalties year after year, decade after decade. This conversation crystallized something important for me. Universal's catalog is essentially a collection of infinitely durable assets generating perpetual royalty streams. The market was valuing it like a normal business with cyclical revenue and limited duration, but that framework was completely wrong. The assets will generate cash for decades, potentially centuries. When you value them appropriately, the stock is extraordinarily cheap. Now let me discuss valuation, because this is where the opportunity becomes truly compelling. Universal Music Group trades at a significant discount to what I believe the business is worth. The market is underestimating both the durability of the business model and the growth potential of the streaming opportunity. Let me frame the valuation in terms of the underlying assets. Universal's catalog represents decades of accumulated hits from the greatest artists in music history. This catalog generates billions in annual revenue with minimal ongoing investment. It will continue generating revenue essentially forever, as long as people listen to music. How much is that worth? Consider that private market transactions for music catalogs have occurred at valuations of 15 to 25 times or more annual royalties. Investors, including pension funds, sovereign wealth funds, and specialized music royalty companies, have paid premium multiples to acquire catalog assets. They recognize that music royalties are stable, growing, inflation-protected cash flows with extraordinarily long duration. Universal is trading at a meaningful discount to these private market valuations, despite being the largest and highest quality catalog in existence. The public market discount makes no sense to me. If anything, Universal should trade at a premium, given its scale, diversification, and management quality. I also value Universal based on future cash flow potential. The company is generating substantial free cash flow today, and that cash flow will grow as streaming revenue expands globally. I model revenue growth in the high single digits to low double digits for the next decade as streaming penetration increases and prices rise gradually. Margins should expand as the high-margin streaming mix grows relative to lower-margin physical sales. Free cash flow will compound at attractive rates for many years. When I discount those future cash flows back to present value using reasonable assumptions, I arrive at a fair value significantly above the current stock price. The market is either not understanding the durability of the revenue streams or not appreciating the long growth runway ahead. Either way, the mispricing creates opportunity. Universal also returns significant capital to shareholders through dividends. The current dividend yield is attractive, and the dividend should grow over time as cash flow expands. For investors who want income while they wait for the market to recognize the company's value, the dividend provides meaningful returns. Let me explain why I think the timing is right for this investment in 2026. Several catalysts could drive the stock higher over the next 12 to 18 months. First, streaming growth continues to exceed expectations. Every quarter, the streaming platforms report subscriber numbers and revenue. When those numbers come in strong, it validates the growth thesis and draws attention to streaming beneficiaries like Universal. I expect continued strength in subscriber growth globally, particularly in emerging markets where penetration remains very low. Second, price increases across streaming platforms will boost Universal's revenue. Spotify, Apple, Amazon, and others have all raised prices recently or signaled intentions to do so. These increases flow directly to music rights holders. As higher prices become normalized, investors will recognize the pricing power inherent in the model. Third, licensing revenue is growing as content production expands globally. The streaming wars among Netflix, Disney, Amazon, Apple, and others have driven massive increases in content production. All of that content needs music. Synchronization licensing revenue is growing as demand for music in film, television, advertising, and gaming increases. Fourth, there is growing institutional recognition of music as an asset class. Major investors have piled into music royalties over the past several years, paying premium valuations for catalog assets. As more capital flows into the space, it validates the value of companies like Universal that own the largest and best catalogs. Fifth, potential strategic transactions could highlight value. Music catalogs continue to trade hands at premium valuations. Any significant acquisition or merger activity in the space would draw attention to the value of Universal's assets and potentially narrow the discount to private market values. Let me share how I think about position sizing and risk management for this investment. Universal Music Group is my largest position because I have exceptionally high conviction in the thesis. The business quality is extraordinary. The growth outlook is strong. The valuation is attractive. The management is excellent. These factors rarely all align in a single investment. That said, I manage risks carefully, even in my highest conviction positions. I size the position based on the probability-weighted range of outcomes. I consider what happens if my thesis is wrong, if growth disappoints, if competition intensifies, if regulatory changes hurt the business. Even in pessimistic scenarios, I believe Universal is worth more than current prices, which provides a margin of safety. I also think about liquidity. Universal is a large, actively traded company. I can adjust my position size if circumstances change. This liquidity provides flexibility that would not exist in a private investment. I monitor the investment continuously. I track streaming metrics from the major platforms. I follow artist signings and releases. I analyze quarterly results in detail. I speak with industry participants to understand competitive dynamics. This ongoing diligence ensures I will recognize quickly if anything changes that affects the thesis. Let me talk about why this investment fits perfectly with my overall philosophy. Throughout my career, I have focused on finding great businesses at attractive prices and holding them for the long term. I look for companies with durable competitive advantages, strong free cash flow generation, intelligent management teams, and significant growth potential. Universal Music Group checks every single box. The competitive advantages are extraordinary. The catalog is irreplaceable. The scale provides cost advantages and negotiating leverage. The artist relationships are deep and long-standing. The brand and reputation attract the best talent. These advantages are widening over time, not narrowing. The free cash flow generation is exceptional. The business requires minimal capital expenditure. The catalog generates royalties without ongoing investment. As revenue grows, free cash flow grows even faster because most of the costs are fixed. This operating leverage is exactly what I want to see in a long-term investment. The management team is among the best in the industry. They have a track record of value creation. They are aligned with shareholders. They think strategically about capital allocation. They communicate honestly about challenges and opportunities. Great management is essential for long-term success, and Universal has it. The growth potential is substantial. The streaming market has years of runway ahead. Emerging markets represent enormous opportunity. Pricing power provides another lever for growth. New monetization opportunities continue to emerge. The growth story is compelling and supported by powerful secular trends. When I find an investment that combines all of these characteristics at an attractive valuation, I bet big. Universal Music Group is exactly that kind of opportunity. Let me address what could go wrong with this investment, because intellectual honesty requires considering the bear case. The biggest risk I can identify is a fundamental change in how people consume music. If some new technology or platform disrupted streaming the way streaming disrupted physical sales, Universal's business model could be challenged. I consider this unlikely because streaming already provides an essentially perfect user experience, instant access to all music for a low monthly fee, but technology can always surprise us. A second risk is deterioration in Universal's relationship with streaming platforms. If Spotify or Apple became significantly more aggressive in negotiating royalty rates, margins could compress. I view this as manageable because Universal has leverage and alternatives, but it is worth monitoring. A third risk is significant dilution of market share to independent artists and labels. If the economics of the music business shifted dramatically in favor of independent distribution, Universal's dominant position could erode. I consider this unlikely because major label services remain valuable, but it is a risk to watch. A fourth risk is regulatory intervention. Governments could change copyright laws, mandate different royalty structures, or otherwise affect the economics of music rights. This is hard to predict and could have meaningful impacts on valuation. I have considered all of these risks carefully. None of them change my conviction in the investment. The margin of safety in the valuation provides protection against downside scenarios. The quality of the business provides resilience against competitive threats. And the ongoing monitoring I do provides early warning if conditions are changing. Let me also address the broader context of why music is such a valuable asset class in today's world. We live in an era of unprecedented content consumption. People spend hours every day listening to music, watching videos, consuming entertainment. Music is woven into every aspect of modern life. It plays in the background while we work. It accompanies our workouts. It provides the soundtrack for our commutes. It enhances movies, television shows, advertisements, and video games. This ubiquity creates enormous demand for music, and because the best music cannot be replicated, because there is only one original version of each iconic song, the owners of that music have pricing power. They can charge more over time because the demand keeps growing while the supply is fixed. Compare this to other content categories. A movie generates most of its value in the first few weeks after release. A book sells mostly in its first year. A video game peaks shortly after launch. But a hit song generates revenue indefinitely. Bohemian Rhapsody was released in 1975 and still generates substantial royalties today. That is nearly 50 years of recurring revenue from a single recording, and it will continue generating revenue for decades to come. This duration is what makes music royalties so valuable. When you buy a music catalog, you are not buying a few years of cash flow. You are buying potentially centuries of cash flow. The present value of that long duration stream is enormous, and I believe the market is still underappreciating just how valuable these assets really are. Let me discuss how Universal compares to other investment opportunities in the current market environment. In a world where interest rates have normalized and valuations have compressed across many sectors, finding genuine growth at reasonable prices has become difficult. Many high-quality companies trade at valuations that already reflect years of future growth. The margin of safety is limited. Universal Music Group is different. The company offers legitimate growth potential, high single digits to low double digits revenue growth for the foreseeable future, at a valuation that reflects skepticism rather than optimism. The market is essentially giving you the growth for free. This combination is rare. Usually, you have to choose between growth and value. You can buy cheap companies with limited growth or expensive companies with high growth. Universal lets you have both because the market misunderstands the business. I have been investing for decades, and I can count on one hand the number of times I have found this combination of quality, growth, and value in a single investment. Universal Music Group belongs in that exclusive group. Let me conclude by summarizing why Universal Music Group is my biggest bet for 2026. The music industry has transformed from a declining business destroyed by piracy into a growing business powered by streaming. This transformation is far from complete. Billions of potential subscribers remain in emerging markets. Prices have room to increase. New monetization opportunities are emerging. The growth runway extends for many years. Universal Music Group is the dominant player in this attractive industry. The company owns the most valuable catalog of music ever assembled. It has the best management team in the business. It generates substantial and growing free cash flow. It returns capital to shareholders through dividends. The stock trades at a significant discount to private market values for comparable assets. The market is underestimating both the durability of the cash flows and the magnitude of the growth opportunity. This mispricing creates an exceptional investment opportunity. I have made Universal my largest position because the combination of business quality, growth potential, and valuation is extraordinarily rare. The risk-reward is as favorable as any investment I have seen in recent years. This is not a short-term trade or a speculative bet. This is a long-term investment in a great business at an attractive price. I expect to own Universal for many years and to generate substantial returns as the market eventually recognizes what the company is worth. The music plays on, the royalties flow, the cash compounds, and patient investors who understand the opportunity will be richly rewarded. That is why Universal Music Group is my biggest bet for 2026. I have never been more confident in an investment thesis. The fundamentals are exceptional, the valuation is compelling, the future is bright. I believe this investment will be one of the defining positions of my career. I believe shareholders who buy and hold will generate outstanding returns over the coming years. And I believe the market will eventually recognize what I already know. Universal Music Group is simply one of the best businesses in the world, and it is available at a price that dramatically undervalues that quality. The opportunity is here. The analysis is complete. The conviction is high. Now it is simply a matter of patience and time. When I look back at my career in 5 or 10 years, I am confident that Universal Music Group will stand out as one of my best investments, not because it was the flashiest or most exciting, but because it combined everything that makes for exceptional long-term returns. A great business, purchased at an attractive price, held with patience and conviction. That is the formula that has worked throughout my career. That is the formula that is working with Universal Music Group. And that is why I am so excited to share this opportunity with you today. The best investments are often the simplest. People will always want to listen to music. Universal owns the best music in the world. The streaming revolution is expanding the market and improving the economics. The valuation's attractive. It really is that straightforward. Sometimes the greatest opportunities are hiding in plain sight. Universal Music Group is one of them. And I believe investors who recognize this opportunity today will be very glad they did when they look back in the years ahead. Let me dive deeper into the economics of the music business, because understanding these details is essential to appreciating why Universal is such an exceptional investment. The music industry operates on what I call a hit-space model with catalog optionality. What this means is that the business invests in developing new artists and releasing new music, knowing that most releases will not become major hits. But when a song or album does become a hit, it generates returns that far exceed the investment required to create it. Here is the beautiful part. Once a hit is created, it joins the catalog and generates revenue indefinitely. The initial investment is a one-time cost, but the revenue stream continues for decades. Over time, the catalog grows larger and more valuable as new hits are added. This creates a compounding effect that most investors do not fully appreciate. Consider the mathematics. Universal spends billions each year on artist advances, marketing, and development. Most of that spending goes toward releases that will not become major hits. But the releases that do succeed generate revenue for decades. The cumulative value of decades of successful releases far exceeds the cumulative cost of all the unsuccessful ones. This is why the catalog is so valuable. It represents the accumulated successes of decades of investment in the music business. All the costs have already been incurred. All the creative work has been done. The catalog just sits there generating cash flow year after year. Let me explain another aspect of the music business that makes Universal particularly attractive. The company benefits from what economists call network effects and switching costs. On the artist side, Universal's roster creates network effects. When Universal represents the biggest artists in the world, it attracts other artists who want to be associated with that roster. Young artists aspire to join a label that also represents legends. This creates a virtuous cycle where success begets success. On the platform side, Universal's catalog creates switching costs for streaming services. Spotify, Apple Music, and Amazon Music all need Universal's catalog to compete effectively. If any platform lost access to the Beatles, Drake, Taylor Swift's early catalog, and hundreds of other major artists, subscribers would flee. This dependency gives Universal leverage in negotiations. These network effects and switching costs reinforce Universal's competitive position over time. They make it harder for competitors to catch up and easier for Universal to maintain pricing power. Let me also discuss the international growth opportunity in more detail, because I think this is one of the most underappreciated aspects of the Universal story. Music is a universal language. A hit song can resonate with listeners across cultures, across languages, across borders. This gives Universal's catalog enormous global appeal. The company does not just operate in the United States and Europe. It generates revenue from every country where people listen to music. Emerging markets represent enormous growth potential. India has over 1 billion people and rapidly growing smartphone penetration, but paid streaming subscription rates remain very low. Brazil, Indonesia, Mexico, Nigeria, and dozens of other countries have similar profiles. Large populations, growing middle classes, increasing smartphone adoption, and nascent streaming markets. As these markets develop, streaming subscriptions will grow dramatically. And when streaming subscriptions grow, Universal's revenue grows proportionally. The company has essentially a free option on the economic development of half the world's population. This international exposure provides both growth and diversification. If any individual market slows down, others continue growing. that geographic diversification reduces risk while maximizing exposure to global growth trends. Let me address another topic that investors frequently ask about, which is the relationship between Universal and the streaming platforms. Some investors worry that Spotify, Apple, or other platforms might eventually squeeze Universal on royalty rates. They point to the platform's large market share and argue that Universal is too dependent on a small number of distribution partners. I see this concern as backwards. Universal is not dependent on the platforms. The platforms are dependent on Universal. Without Universal's catalog, Spotify would lose a third of its content overnight. Subscribers would cancel in droves. The entire value proposition of unlimited music streaming would collapse. This dependency gives Universal significant leverage in negotiations. The platforms cannot walk away from Universal without destroying their own businesses. They have to pay competitive royalty rates to retain access to the catalog. Furthermore, the platforms compete with each other. If Spotify tried to squeeze Universal on rates, Apple could offer better terms and sign exclusive content deals. This competition keeps the platforms honest and prevents any single platform from extracting too much value from rights holders. The relationship between Universal and the platforms is symbiotic, not adversarial. Both sides benefit from growing the overall streaming market. The platforms need great content to attract subscribers. Universal needs effective distribution to reach listeners. This alignment of interests makes negotiations more constructive than many observers assume. Let me share my thoughts on capital allocation at Universal, because this is an area where management quality really shows. Universal generates substantial free cash flow that must be deployed wisely. There are essentially three options for that cash: return it to shareholders through dividends and buybacks, reinvest it in the business through artist signings, acquisitions, or infrastructure, or let it accumulate on the balance sheet. Under Grange's leadership, Universal has struck an excellent balance. The company pays an attractive dividend that provides shareholders with current income. It invests appropriately in artist development and strategic acquisitions, and it maintains a strong balance sheet that provides flexibility for opportunistic moves. This disciplined approach to capital allocation is exactly what I want to see. Management is not empire building or pursuing growth for its own sake. They are focused on returns and shareholder value. Every dollar of capital is deployed thoughtfully with an eye toward long-term value creation. One area where Universal has been particularly smart is catalog acquisitions. When iconic artists or their estates decide to sell music rights, Universal is often the buyer. These acquisitions add high-quality assets to the already exceptional catalog. And because Universal has expertise in monetizing music rights, they can often generate better returns on these acquisitions than other buyers could. Let me also discuss the dividend, because income is an important component of total return for many investors. Universal pays a meaningful dividend that has been growing as the business grows. The current yield is attractive relative to other quality growth companies, and because the business generates substantial free cash flow with limited capital requirements, the dividend is well covered and sustainable. For income-oriented investors, Universal provides a growing stream of cash payments backed by irreplaceable assets with pricing power. This is exactly the profile that retirees and other income-focused investors should want. The dividend provides current income while the underlying business continues to appreciate in value. I expect the dividend to grow at a healthy rate for many years as streaming revenue expands and margins improve. This dividend growth will compound over time, generating substantial income for patient shareholders. Let me address the question of timing, because some investors wonder whether they should wait for a better entry point. My view is that trying to time the market is almost always a mistake. I have been investing for decades, and I still cannot predict short-term price movements. What I can do is identify great businesses trading at attractive valuations and buy them. Universal Music Group is a great business trading at an attractive valuation today. Waiting for a better price means risking missing out on the opportunity entirely. The market could easily recognize Universal's value and bid the stock higher before any pullback occurs. The right approach is to buy quality when it is available at reasonable prices. Universal is available at reasonable prices today, therefore, today is a good time to buy. That said, I always recommend building positions gradually rather than investing everything at once. Dollar cost averaging into a position reduces timing risk and provides emotional comfort during volatility. If the stock drops after your initial purchase, you can add more at lower prices. If it rises, you still have meaningful exposure. Let me share some thoughts on why music as an asset class deserves more attention from serious investors. For most of investment history, music royalties were not accessible to outside investors. The record labels owned the rights and kept the cash flows. Individual investors could not participate directly in the economics of hit songs. That has changed dramatically over the past decade. Music royalties have become recognized as an attractive asset class with characteristics that appeal to sophisticated investors. Pension funds, endowments, sovereign wealth funds, and private equity firms have all allocated capital to music rights. Why the sudden interest? Because music royalties offer a combination of features that are hard to find elsewhere. Long-duration cash flows measured in decades, inflation protection because streaming prices can rise with inflation, low correlation to traditional asset classes, recession resilience because people continue consuming music during downturns. This institutional recognition of music as an asset class is still in early stages. As more capital flows into the space, valuations for music assets should continue rising. Universal, as the largest and highest quality owner of music rights, stands to benefit enormously from this trend. Let me also discuss the moat around Universal's business, because competitive advantage is essential for long-term investment success. Universal's moat has multiple layers. First, there is the catalog itself. Those recordings cannot be replicated. They are permanently scarce assets with enduring cultural value. Second, there is the artist relationship network. Universal has spent decades building relationships with artists, managers, agents, and other industry participants. These relationships create information, advantages, and access that competitors cannot easily replicate. Third, there is the institutional infrastructure. Universal has offices around the world, expertise in international licensing, sophisticated royalty collection systems, and deep knowledge of complex copyright laws. This infrastructure took decades to build and would be nearly impossible for a new entrant to replicate. Fourth, there is the virtuous cycle of success. Success attracts success. The best artists want to work with the best label. The best catalog attracts the best new talent. This reinforcing dynamic makes Universal's position increasingly impregnable over time. Each of these moat layers would be valuable on its own. Combined, they create a competitive position that I believe is essentially unassailable. Let me share some final thoughts on why I am so confident in this investment. I have been investing professionally for decades. I have seen bubbles inflate and burst. I have watched entire industries transform. I have made money and I have lost money. Through all of that experience, I have developed a sense for what makes a truly great investment. Universal Music Group has all the characteristics I look for. The business is simple to understand. The competitive advantages are enormous. The management is excellent. The growth prospects are substantial. The valuation is attractive. The risks are manageable. When all of these factors align, I invest with conviction. I size the position according to my confidence level, and I hold for the long term while the investment thesis plays out. Universal Music Group is exactly that kind of investment. The alignment of factors is exceptional, my conviction is high, and my time horizon is measured in years, not months. I believe this investment will generate attractive returns for shareholders who buy and hold. The combination of dividend income and capital appreciation should produce double-digit annual returns over a multi-year period. That is an excellent outcome in any market environment. More importantly, I believe this investment is low risk relative to the potential reward. The downside is protected by the irreplaceable catalog and recurring revenue streams. The upside is substantial as the market recognizes the true value of these assets. This asymmetric risk-reward profile is exactly what I seek in every investment. That is why Universal Music Group is my biggest bet for 2026. The opportunity is exceptional, the timing is right, and I could not be more excited to own this business for the years ahead. Let me leave you with one final thought about why music matters as an investment. Music is not just a business. It is a fundamental part of human experience. People have been making and listening to music for as long as civilization has existed. It is woven into our celebrations, our mourning, our worship, our entertainment. It accompanies the most meaningful moments of our lives. This universality is what makes music such a durable asset class. As long as humans exist, they will want music. The technology for delivering music may change, the formats may evolve, but the underlying demand is constant and eternal. When you invest in Universal Music Group, you are investing in that fundamental human need. You are buying a piece of our cultural heritage. You are owning the soundtrack of multiple generations. And you are positioning yourself to benefit from the continued growth of an industry that serves a permanent human desire. I find that deeply appealing, not just financially, but philosophically. I want to own businesses that serve enduring human needs with products that people love. Universal Music Group is exactly that kind of business. The music plays on, the royalties compound, the value grows, and patient investors who understand this opportunity will be rewarded handsomely for their insight and discipline. 20 years from now, I believe we will look back at 2026 as a pivotal moment for Universal Music Group shareholders. The streaming revolution was still unfolding. The emerging market opportunity was still largely unrealized. The institutional recognition of music as an asset class was still developing, and the stock was still trading at a significant discount to intrinsic value. Those who recognized the opportunity and invested with conviction will have been richly rewarded. Those who waited or doubted or second-guessed will have missed one of the best investment opportunities of the decade. I know which group I want to be in, I know which group I am in, and I hope that by sharing this analysis, I have helped you understand why Universal Music Group deserves serious consideration in any thoughtfully constructed portfolio. The case is compelling, the timing is favorable, the execution is straightforward. All that remains is the decision to act. I have made my decision. Universal Music Group is my biggest bet. Now you must make yours. I'm confident that those who choose to invest alongside me will be very pleased with the outcome in the years ahead. Remember what I said at the beginning of this discussion. The best investments combine durable competitive advantages, strong management, attractive growth prospects, and reasonable valuations. Universal Music Group excels on every single dimension. That combination is extraordinarily rare in today's market, and it is why I have such high conviction. Thank you for your time and attention. The music plays on.